Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Good to be back and good to be back for another podcast, Billy. How you going?
Andrew, it's always good to be here with you recording these things. So I'm going well and things are good. Can't complain. What about yourself?
Nice. Yeah, much the same, Billy. Much the same. Can't complain at the moment. I was about to say that the weather's starting to heat up and look a bit better, but it's certainly not the case here in Melbourne. We're going through a winter in the middle of spring.
Mate, you're absolutely right. I mean, we've got the opportunity now where things are starting to open up for us and we're getting a lot of our freedoms back. But Melbourne being Melbourne has been consistent with the weather and causing us to stay indoors. Unfortunately, it's not great at the moment, but we digress. We digress for sure.
Nah, very nice, very nice. And the other thing that's been happening post-lockdown is that the property market's opened up in Melbourne, and that's the topic of conversation today, isn't it?
Very topical. We're getting a lot of interest from a lot of our clients, a lot of people that we're talking to. I mean, property, especially in Melbourne and I guess Sydney as well too, but it just seems to be the national sport and has been for such a long period of time. However, at the moment, and this topic that we're going to talk about is very, very relevant now, but at the moment, Andrew, it's just on a different level and it's something else. It has gone berserk. That's the best way to put it. And we're getting a lot of inquiries from people who are not only interested in getting in, but it's also causing a lot of concern and trepidation as well too, because people are just looking at this thing and the price guides are not accurate. The deposits that they need are being blown out. Serviceability is becoming a slight issue as well too. So we're going to run through all of that today and hopefully give our listeners some insight into what's happening and hopefully some peace of mind around some things that we do and how we're looking at it in order to combat some of these things.
Yeah, absolutely. Absolutely. I mean, we're seeing a market that's changing very rapidly, a market that's moving very quickly. And ordinarily, I think you kind of expect there's a little bit of upward pressure on the price guide when you're looking at a property online. But I think what we're seeing is that pressure is really...
it's something else.
Oh, it's absolutely insane. So hopefully we can start to decipher a little bit as to what's causing this rise in property prices, what's been happening in the market, and sort of share some of our insights and some of our knowledge into, in particular, the Melbourne property market. I mean, really, it is sort of something that's impacting pretty much the whole of Australia, but in particular, Melbourne, where we are.
To put some context, Andrew, I'm going to throw you in this, to put some context around sort of what we're talking about. And we can talk percentages rather than dollars, but obviously you're in the market at the moment.
Yeah.
So maybe we can also reflect on some of the stuff that you're seeing firsthand and experiencing, because, you've had some interesting experiences with what's happening in your own personal life with your property journey right at the moment. So maybe we can lean into that a little bit. And if we want to talk percentages rather than dollars, that's fine as well too, but it'll give our listeners some insight exactly into what's happening. And as early as, a week ago, that was the last auction I think you went to. So
yeah, exactly.
We can lean into that. Yeah.
Obviously still haven't been successful if you can hear the depression in my voice. I mean, look, I'm also some personal insights in the market for a larger family home in the area. And it's ridiculously competitive out there. I mean, from personal experience, you're seeing prices that are tipping 20% over the maximum range that agents are sort of quoting online. You're seeing bidders of 7, 8 bidders where previously you might have seen 3 or 4 bidders at an auction. And people are just they're going really hard in bidding and they're making their intentions very known. And it's reflective of what's happening in the broader market and something that I'm experiencing as well. So for all those out there that are also looking for property, I definitely feel your pain. But look, there's hopefully going to be some light at the end of the tunnel.
Yeah, I mean, what was interesting about that one, and that was the auction that you went to last weekend, the price guide was, I thought, reasonably priced when they were doing the advertising campaign. And I think it was 3 or 4 days before the auction, the price guide increased by $100,000.
It was actually the day before the auction. It was about 12 hours before the auction. Jeez. The night before, they increased the price guide. So I don't know whether there was an offer or reserve price went up or what caused that.
And then where did it end up above the higher end of the price range? Because it blew that out of the water as well too, didn't it?
So after that increase, that $100,000 increase, it still ended up 20% above the highest end of the range. So, and that's the fact of the matter is it's uncommon. I mean, whenever you're sort of on your property journey, and whether it's your first, second, third, whatever property it is, you start to realize that there's going to be some outliers. You're going to look at some properties and expect it to go for a certain price, and for whatever reason, someone falls in love with it, someone gets overly emotional, whatever it is, there's going to be some prices that are going to go well above and beyond the price guide. And obviously, we hope that that's not our clients that are doing that bidding. But that's not uncommon with what we're seeing in the market, and not uncommon with what I'm seeing in my personal journey. There's the price that properties are selling for are consistently selling well above and well above reserve prices. You're hearing it at auctions. You're hearing the agents say that the property is on the market, and it's on the market 300,000-400,000 before the property actually sells.
It's just insane. Yep.
Yeah. And I mean, tell us, what are some of the headline numbers? What are the headline percentages about what's happening in broader market, or what's been happening in the broader market in Melbourne, Bills?
Well, median house prices are now over $1 million in Melbourne.
Wow.
Yeah. So that's a huge number. It speaks for itself. $1 million for a home median. That is the number.
Especially when you consider the wage in Melbourne and you sort of use it in comparison to that. That's a pretty hefty figure.
If you think that number's big, listen to this. So this comes from Domain, 16.8%. That's 16.8% annual price increase in property prices.
Wow.
Absolutely huge. That's for housing. For units, they rose by 6.1%. So obviously they don't perform the same way. And we'll talk about some of the factors and bits and pieces why we think that's the case and why people are rushing to property and pushing things up. And COVID's got a little bit to do with that in bits and pieces. Broad brush sort of statement, outer east and northeast were the highest performing areas in the Melbourne area or in the Melbourne market. But we're seeing some huge numbers at the moment, and demand still continues to be there and continues to push prices up.
And that's on another level. I mean, for those that are property investors out there, you also take into account the fact that there's also some income off the back of these assets as well. So if you're investing in property, you're not only having exposure to capital growth, but you've also got exposure to the rental income that's also coming in on top of that. So that's some pretty insane numbers in terms of property growth, and all taking into account the fact that I've actually lost track of what it is, but how many months of the year? It was probably about 3 months of the year that we were actually locked down over the course of the last 12 months. So
a lot of pent-up demand. But just going back to that headline number, and I know that it wasn't this because this helped push it up, but assume that the median house price, $1 million, which we know is the case, 16.8% on $1 million is $168,000 in a year.
Unbelievable.
Absolutely unbelievable. That's crazy. And obviously property is that type of asset class that in order to get into it, you need to put a lot of money down. So a 16% increase on anything is a huge rate of return, but on the fact that it's on an average property price of $1 million, the absolute return is huge. Absolutely. So,
and so you consider the first home buyers out there, the people that aren't already in the market, it does cause a pretty substantial issue in terms of, and we're starting to see some of that rhetoric come through in the media of housing affordability and how people are going to be able to get into the market. It's causing some larger issues on a broader scale. If you're not already in the market, I guess if you're in the market, you ride that wave as the prices increase. So does your equity position, your asset position, and ability to borrow. But if you're not already in the market, it certainly causes some issues in trying to get in, and it makes things significantly more difficult.
I think it's always been a challenge as well too, though, especially for first home buyers. I mean, it's interesting when you think about the amount of money that you need in order to get to a property, deposit, stamp duty, if it's applicable. Maybe it's not because you're getting some of the concessions and bits and pieces. But I've always found, as a sort of broad brush statement, that your savings, generally speaking, do not keep up with the pace of property price growth, which makes that target of getting the deposit, it's getting further and further away. And there's only so much you can do in order to accelerate your savings. So once again, it does create some issues for the broader society, housing affordability. We talk about stock, Is there enough on the market? If supply and demand's out of whack, it's obviously driving the prices up a lot faster and stuff. But that could be a good segue, Andrew, into some of the stuff that we are seeing with these big numbers being put forward. And you're hearing about these auction campaigns that the reserve price is here and it's being sold, way above and beyond that. Let's talk about some of the factors that we see as to what's really driving this. See if we can dig a little bit deeper and figure that out.
Yeah, so look, there's a few things that have impacted the rapid rise in property prices and a few things that have happened. We already touched on the fact that for the better half of about 3 months, we were in lockdown. That not only included a lockdown in terms of being in lockdown personally, but also the property market. So the property market was closed. A whole bunch of people that realized it for whatever reason, whether that's wanting to upsize, whether that's now starting to work from home and need a larger space, for whatever reason, wanted to purchase another property. They wanted to buy and there was absolutely no supply because there were no properties on the market. So you've got this supply and demand issue where there's pent up demand from the previous 3 months. And all of a sudden, all of those buyers are there, ready, willing to compete at whether it's auctions or private sales, and they are pushing the prices up. I mean, you've got a large amount of demand, a limited supply. I guess people that were selling were also cautious of what's going to happen with the market. So not wanting to be the first person on the cab rank, not wanting to be the first person to sell. And so we saw very little supply on the market with a huge amount of demand, and that competition resulted in some pretty hefty rise in prices.
So pent-up demand and fear of missing out. Really.
Exactly right.
Yeah.
Yeah, exactly right.
The other thing that I sort of experienced, and this is probably an experience closer to home for us. So Samantha and I obviously moved to working from home. We were quite fortunate that we could do that with no real issues, just because of the stuff that we do for a living. We also moved to homeschooling, which wasn't great. But what that did do, and I'm really fortunate in terms of where I live, and there's a bit of space and there's enough bedrooms and we've got a study and bits and pieces and stuff. But what it really did is it focused my attention on if we weren't in the place, so if our house didn't cater for our needs, that would have been front and center, right in front of our eyes. And we'd be saying to ourselves, hey, we need to do something about this. And I think what it's done is it's given people time to think and reflect and say, hey, is this a long-term shift to working from home? Are we only going to go when we can go back into the office? Are we only going to do it a couple of days a week? So I need my home to be able to have a dedicated study where I can set up and work from home and close the door and not be interrupted in bits and pieces like that. And what I think it's done is a lot of people are looking at their current circumstances, and that's triggering them to think, hey, we want to do something different and we want to trade. So that then goes into sort of what you said before about having more and more pent-up demand. And I don't know, are we seeing more of a structural shift towards that?
Yeah, we are. We are seeing, and you're already seeing it in the headline numbers, and I don't even think that this has fully come into effect yet. But a 16.8% annual rise in housing prices and a 6.1% annual rise in unit prices is reflective of the fact that people are looking for more space. People are looking for larger homes. There's a greater demand towards that, which is why those prices are starting to rise at a more rapid rate. So I think a lot of people in the boat that I'm in, essentially, which is you're at a smaller place, you either are looking to start a family or you've already got a family and you realize that while you're at home and while you've been working from home, you need some additional space. And people are starting to make that move to the larger properties, which in turn is pushing the prices up. So yeah, absolutely.
Yep. Let's not discount the fact as well too that I guess Melbourne in particular, savings rates. We haven't had the ability to spend, I guess, money the way that you used to, going out, traveling in particular. So what we're seeing is increased savings right across the board, which ultimately leads to having additional capacity to be able to put more into property. So we're also seeing that that's playing out as well too, and that's helping push up prices as well because people have more resources to throw at it.
Absolutely. As you said at the start, like how a property purchase is something that really, it does take a substantial amount of funds. It takes a substantial amount of effort to get to. And what the largest or one of the largest contributing factors that prevents someone from purchasing a property is a deposit. Yeah, there's servicing. Yeah, there's the decision-making process around, is this the right asset class to be going into, and all of that stuff that comes into account. But if you fall over at the first hurdle and you don't have the deposit, then everything else is relevant. So as people were staying at home, we were pretty fortunate as well that there was also some government subsidies that were coming in as well, so that even if you had lost hours, that it wasn't overly detrimental. You weren't going out and eating out every night, unless you were doing a whole lot of Uber Eats or anything like that. But what we did see, and did come in the statistics as well, was a high amount of savings. The household savings increased. And as a result, people are looking for ways to spend it. And I dare say that one of the smarter ways to spend it is put it towards an asset and put it towards a property. And people are certainly doing so. And that's contributing to the rise in property prices as well.
Yeah, well said, Andrew. And I think just in case that wasn't enough, I think there's a little bit of a cherry on top, which is probably not necessarily the cherry on top, but maybe the fuel that sits underneath all of this is the interest rates have been low and ridiculously low for a long period of time, which makes money cheaper and cheaper to borrow. We've had, I guess, relatively speaking, fairly loose or lax lending standards in Australia. You can borrow up to 6 to 7 times potentially household income. You go and couple that with a low interest rate environment and people are borrowing $1 million in order to get into their property, and there you go. That just helps to fuel that growth as well too.
Absolutely. I mean, the regulators have really been trying to stimulate the broader economy by retaining interest rates quite low. And so what you're seeing is the share market is also performing well. You're seeing other markets that are also performing well as a result of it, which is no doubt the intention of keeping interest rates low. But a byproduct of that is that property market is really being fueled by a low interest rate environment. You consider the opportunity cost of buying versus renting. If you've got the deposit, for most people, there's very little to no difference from a cash flow requirement, whether you rent or own the property that you live in. Particularly, and this is even on principal and interest, but particularly when you're talking about interest-only loans and the availability of all of these different options, there's almost no net cost to own a property other than the loss of savings in your savings account in the form of a deposit. But there's almost no difference from a cash flow perspective, depending on the property and what you're looking at, obviously. But it's really, and in turn, pushing rental prices to remain stagnant or even in some markets decline.
Yeah, well summarised. And it's probably a good segue into what do we think and what are we seeing in terms of what the future holds. And with that, we're talking about interest rates and some of the changes that APRA in particular are making to sort of lending criteria and serviceability. In particular, they're trying to make it, I wouldn't say harder, but they're just trying to let a little bit of the air out of the balloon, if that's kind of a good analogy that we can use, to make it in terms of how much money people can borrow, just take a little bit out of that. So what they're attempting to do, because I guess we're really faced with a problem as a society, right? I mean, we want to stimulate the economy, which interest rates or low interest rates are traditionally the lever that's used to do that, and encourage people to borrow money, invest it back into businesses and the economy and stimulate growth that way. What it's done traditionally for us, at least here in Australia, is it's allowed people to borrow a lot more money. It's allowed property prices to go essentially through the roof. The government's in a position now where they need to start increasing interest rates, but they need to try and slow down the property market, but they need to keep interest rates low to encourage businesses to borrow money in order to put it back into the economy. So what they're doing is they're taking a different approach rather than increasing interest rates, because yes, that will have the desired effect on the property market, but it will have a detrimental effect to businesses who want to borrow money, buy plant, buy equipment, expand their operations. So one of the things that they've done recently is they've increased the serviceability rate from 2.5% to 3%. So essentially what that does is if you're borrowing money on an interest rate of 2%, the bank will assess your serviceability on 2.5 times, or 2.5%, I should say, above what that rate is. So in that instance, they'll assess your ability to repay on 4.5%. What they've done recently is they've increased that to 3%. So they will assess your ability to repay on a 5% interest rate. So they're just trying to build a few more buffers in to make sure that if there are shocks in the economy, one, we can absorb it, and two, making sure that people can afford to pay back what they are borrowing. And then I guess that's the real intent of what they're trying to do. And they're hoping that that will translate to taking some of the heat and some of the steam out of the property market that we're seeing at the moment.
Yeah. So as you sort of touched on, and this is a fairly lengthy topic of conversation anyway, but a lot of people think, and a lot of the questions and sort of thoughts that we get, not just from clients, but your friend and family at a barbecue and all of that stuff is, well, why don't they just raise interest rates? If they raise interest rates, the property market's going to slow down, and there you go, problem solved. But there are far more levers at play in this and far more ramifications that happen off the back of a decision like that. As you say, it's very likely that if that's happening and interest rates are rising, that there's going to be a implication to the share market and the broader economy within Australia, which the government doesn't want to do. And so what we're seeing is there is some talk of interest rates rising, and we're starting to see some banks move up in terms of the interest rates that they're offering to their customers. But the lever that they're trying to pull is to isolate just the property market and really just take some of the air out of the tires and let that market normalize to some degree. And so the decisions, and this is no different to what we've been seeing in the past. I mean, we saw a few years ago, they pulled the same lever. They introduced responsible lending. They took some of the heat out of the market, realized that they had gone too far, then started letting some more air back into the tires. And this is a lever that's been used in the past in isolating the borrowing capacity of people that are purchasing and using that as a means to start to control and grapple onto what's happening in the property prices. And so we're seeing some of those levers being pulled, as you mentioned, Billy, the interest rate ratio or what they're using in that regard. They're also making and proposing some adjustments in relation to multiple of household income and how much you can borrow based off that. So there's some levers that they're trying to pull to take the air out of the tires and the heat out of the market.
Yeah, well summarized. I guess ultimately it comes down to sort of one thing. I mean, what do we think is the direction of the property market in terms of what we're seeing? We've got a couple of different things at play, which we had summarized. At least in Melbourne, with restrictions continuing to ease, we're seeing more and more stock come onto the market. So hopefully over time, we see that demand and supply side sort of go back into equilibrium. That'll take a little bit more time. I think there's a bit more to run on that. We're seeing measures
especially with the Christmas break and the break between Christmas and New Year in the property market. You sort of get another period of time where properties aren't listed and there's a stagnation in terms of supply.
Yeah, no, absolutely. Everything seems to go to sleep over the Christmas break, no doubt about it. So we're seeing more stock come onto the market, which should over time put supply and demand back into equilibrium. Whether that happens or not, we'll wait and see. I think there's always been a supply issue in Melbourne. When you factor in immigration, that issue hasn't been a consideration of late because international borders are locked. When that actually changes down the track, will we see property prices get another kick? Yep. I'm not sure. The changes that APRA have made, we obviously need a little bit of time to see what the impact of those are. And then in terms of the interest rates, you touched on it before, Andrew, we are seeing increases in fixed rates, which is interesting. Obviously, the bond yield has started to go out, which means it's more expensive for banks to borrow money. So they're obviously passing that cost on to borrowers. Where do we see it going in the next 6 to 12 months?
Look, I think that anyone who says or knows that the property market or the share market or anything is going to go in a certain direction and they're not a multi-billionaire is guessing, or whether that's an educated guess or not is
speculating.
A question. Yeah, I mean, really, you're speculating how these levers are going to pay out or going to play out, how far they're going to push these levers. So whether they're going to start increasing the fixed rates even more so, whether we see a rise in variable rates, whether we see the actual legislation around borrowing criteria or requirements around borrowing, the degree at which that's implemented is also yet to be seen. There's so many moving parts that it ultimately is impossible to decipher which direction and to how much the property market will go. I think it's fairly safe to say And in any investment decision, it's important to make sure that you receive advice, make sure that you really decide before you decide. An auction is usually the big one where people get excited. Make sure that you decide on the value of that property, where you see that and where you think it should be priced, and don't overcommit. Don't get excited.
Which is exactly what an auction is designed to do, is to get people excited in the theatre of it. And yeah, obviously put your hand in your pocket and dig out more than what you were prepared to pay initially, right? So I think we've all been in that position.
Exactly. So make sure that you're not overcommitting, you're not getting overexcited. This period of time where the market is excited cannot last forever. Whether it lasts for a period of time and it stagnates, whether this is gone crazy and the market collapses, whether the market continues to rise, albeit at a more sustainable pace, is impossible to decipher. So making a decision based on the available information and what you've decided beforehand is really ultimately the most important factor.
I guess just to close out on sort of the leading indicator, I mean, clearance rates is probably your best indicator of where the property market is in terms of supply and demand and the direction of property prices. We're still seeing really high clearance rates.
Absolutely.
So that's probably the best indicator that you can see. In saying that, when it does turn, it can turn quite quickly. But from all accounts, in terms of the real estate agents and people that we're speaking to, we still think that there's a bit to go in this run. And let's see how that plays out, especially after Christmas and what happens from that perspective. But all of the issues that we had seen sort of leading up to this, some of them are starting to alleviate, like being able to get back out to spend your money in bits and pieces. Some of them are still present. And I think like the work from home thing, and I think that's going to be a structural shift, thinking about where you're going to work. Is it a study? Geez, I'm working on the kitchen bench. No, I need to upgrade. I need an extra bedroom or whatever it is. So those things I think are going to remain as permanent shifts in our thinking and our psyche. But either way, it's going to be exciting to watch and see where this thing goes.
Yeah, absolutely. So yeah, thanks very much for the podcast, Billy. I think that was really insightful, really topical, and really enjoyed doing that one with you.
Thank you to Andrew. And once again, thank you to our listeners for your attention. Hopefully you got some value out of today's podcast. And like always, if you've got any questions or wanted to get some further information, feel free to reach out. Contact details in the show notes, and we'll catch you on the next one.
Thanks very much for listening, and looking forward to recording the next one for you.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorised representatives and credit representatives of AMP Financial Planning.